Okay, I think we can get going now. We have a critical mass. So good afternoon, good morning, good evening, depending on your time zone. Thank you for coming to our panel discussion titled The Unexpected IPO Boom for Biopharma in Q2. We will touch on a variety of topics, including how COVID-19 positively impacted IPOs in Q2. We do have 1 hour allocated for the panel, including questions that we have prepared in advance, as well as questions received in advance from the audience, as well as the participants. If you have any questions that you want us to address, please submit them through the Q&A system at the bottom of your screen. I will read out the most frequently asked questions and ones that have the broadest applicability to the audience at the end or interspersed as relevant. If we do not have time to address your question, we'll follow up separately with our thoughts. We will be recording this session and a playback will be available shortly afterwards for attendees. I am also obligated to share that due to confidentiality obligations and other regulatory requirements, we will not address questions specific to any one company. This is also not considered legal advice or an offer to buy or sell any security. Everything discussed is considered strictly off the record. So I want to thank the panelists who have joined this discussion. This is going to be a special panel because all these panelists have just been through a successful IPO or have advised them directly in the immediate past future in June of this year, actually. And they're all going to share their experience and insight with you. I will introduce them all briefly, and then we'll get to the content. So starting off, we have Liz Bott, the Chief Business Officer of Applied Molecular Transport. She joined Applied Molecular Transport to lead multiple business functions, including corporate development and strategy, alliance management, portfolio strategy, and project management, and then also commercial development. Liz brings more than 25 years of biotech and pharmaceutical company experience, including roles in corporate development, corporate strategy, and commercial strategy. Sean Cross, the Chief Financial Officer of Applied Molecular Transport, joined in 2020 this year, I believe in March, where he leads the company's finance strategy and oversees financial operations. He brings over 20 years of biopharmaceutical investment banking, strategic advisory, and capital markets experience, during which time he worked both domestically in New York and San Francisco, as well as internationally in London, covering both SMID and large cap biopharma companies. Interestingly, because of his banking experience, there'll be some juxtaposition with Liz, given she was doing a lot of the work before he joined. So we'll get some unique perspectives there. Todd Shagag, CFO of Forma Therapeutics. He joined the company in September of last year, and he has over 25 years of financial experience in the biotech and pharmaceutical industries. I'm sure there's a lot more to him, but he declined to add to his bio. So there you go. Sio Salimi, last and not least, thank you for joining, is a partner at Goodwin's Life Science Capital Markets Group. His practice focuses on corporate transactions and securities laws, with a particular emphasis on representing life science companies and underwriters in public and private capital markets transactions, such as IPOs, follow-ons, private placements, equity, debt, everything you would expect for a biotech to raise capital. So without any further ado, let's go for it. First question, and maybe I'll just have CEO kick it off. Are we partying like it's 1999, or is this sustainable? If so, for how long? This is a long question. I'll give you a chance to respond. Just bear with me.
Yeah.
Is it really different this time? Everyone says this is going to be different. Or because biotech's going to save the world, will we defy the laws of gravity, or will they be reapplied at some point soon? How do you advise companies to think about access to capital now versus the future? So give me your crystal ball. Help us understand how to make sense of Q2, which seemed to be illogical.
There's a lot to unpack there, and I'm happy you read the legal disclaimer that this isn't investment advice, but I'll give it my shot here. So yeah, it's interesting, right? 2020 has obviously shaped up to be a lot busier than any of us expected, and definitely remarkably different from 2019. I think of it akin to 2015, 2017. We're seeing a lot of preclinical companies get out, whereas in 2019, you were seeing phase 1 companies or even phase 2 companies getting out, and preclinicals weren't really getting much love, even with POC established. Your question on science always grows at exponential rate. Technology, the preclinical model accuracy, the deeper understanding. Think of where gene therapy is now compared to the 1990s, where very different studies back in the 1990s with gene therapy. But I think there's other fundamental factors that play in 2020. One of them I can think of is, the XBI is pretty well outperforming the S&P. So I think we're seeing not just the general fervor from biotech investors, but also kind of a move over from the generalist investors and deploying funds into, I'll call it a safer bet at this point, and move money away from the S&P, which is adding to the demand. We're seeing the upsized IPOs. We're seeing everything come north of 200 million, which last year would have been, a huge home run, but we're seeing it pretty regularly now. I think it's full steam ahead for Q3. We've already seen 4 companies price. I think everyone that I know in the industry has a pretty big backlog of companies that are ready to flip or ready to get on file. And hopefully for everyone here, the momentum carries for the year. Crystal ball in the future? I don't know, but I think the adage for biotech companies is take the money when you can or run, right? I'm being a little glib, but if you have a chance to get out, I think everyone's trying to get out right now.
Yeah, makes sense. And Sean, maybe since you were most recently a banker, but now you're a reformed company guy, again, what are your views on this, and how has your view changed, perhaps going back to the company side?
Yeah, I guess if it's a crystal ball question, I think it is interesting in that, but at least the first time in my career where biotech is viewed as defensive, and I think we're at the tip of the iceberg. Your opening comments with regard to innovation, and there's a lot of tremendously exciting things happening in the industry. But the fact that it is viewed as defensive, we did see largely demand from the usual suspects and the large mutual fund complexes and biotech dedicated funds. But it was interesting seeing some of the generalist growth funds looking at least at our deal, and I'm sure other deals, because of this sort of defensive view of biotech, which is surprising considering there's binary risk, but I think overall it's great for the industry.
So laws of gravity, I imagine you believe will be reapplied at some point. Is that fair, or what do you think?
Yeah, I mean, I think you have to assume that's going to happen, and I think it's just incumbent upon everybody in my seat and the way Liz thinks about the world, and I'm sure Todd as well, that it's sort of a massive parallel process in how you fund these businesses going forward. And I agree, raise money while you can. We ended up doing a deal that was right sized for our company based upon our needs. But it would be very logical for all of us to think about, what's the next financing? What does it look like? Whether it's in the form of business development or something more creative or regular way equity deals. But I think the laws of gravity will happen at some point. But at least then, I don't know that we'll have the sort of dramatically open and shut windows like we used to see in the past, just based upon the evolution of the science and the depth and breadth of the space like we've never seen before.
Got it. So maybe that's a good segue, and I'll address this one to you, Liz. Talking about timelines for raising capital and right sizing it relative to your needs. How was your original financing timeline? How did that square with the new COVID timeline, and what type of changes or adjustments did you have to make to, as CEO talked about, kind of take advantage or capitalize on a situation where everyone wanted to get out?
Yeah, so we actually had started the process far before COVID actually started. We had begun contemplating what our next round of financing, to Sean's point, well in advance, and thinking about this actually in Q4 of last year. We were actually coming out of stealth mode, so spent a lot of time on non-deal roadshows just to kind of assess what the environment was like and see what our options were, keeping optionality really an important part of our decision-making process. You have to remember, at the end of last year, obviously no one was worried about COVID. Everyone was worried about the presidential election and what was that going to do to the IPO window. And of course, everybody had a lot of opinions, but we certainly needed to be thinking and planning around that. And so after JP Morgan, we had really done enough assessment and thought about, starting our process at that particular point in time, and orged up at the end of January. But then COVID hit, obviously. So we had fortunate enough to have met with investors face-to-face prior to the process and really begun those introductions, which was nice. So we had some FaceTime and didn't have to do everything fully virtual, but certainly had to make an adjustment when COVID hit. And paused our process. We'd already filed our S1, but really needed to think about our options at that particular point in time, and how things were going to change during that period of time. In the middle of February and March, when we were on our TTW meetings, nobody really knew how things were whether the market was going to bounce back, The investors were really seeing rapid drops within their current portfolios as well. So it was really an uncertain time. And so we certainly had to take a pause in our process just to reassess things and see what our other options might be should things not go as they did.
So how did you then make the call once the market turned to push the foot in the accelerator again? What was that process like?
Yeah, it was really, seeing how things really had developed, keeping an eye on the few IPOs that were brave enough to really tread out there during that period of time, seeing how the market responded to those, how the raises went, and how they performed in the aftermarket. Obviously, consulting with the bankers in terms of what the vision was going to be going forward. But once the trends seemed to stabilize, because we were already actively in the process, being able to turn the engine back on actually was relatively straightforward. But you can certainly, every week we were cautiously looking to see what was happening, just to make sure that whether we would need to readjust. And as I said, optionality is really important, and really making sure you have alternative plans should things change again. And that was something we talked about frequently.
It makes total sense. So Todd, maybe you can kind of same question, think about your pre-pandemic timeline and how that changed relative to the pandemic and how you were thinking about it.
Yeah, certainly some very similar parallels with Liz. We closed our crossover round in middle of December, and that was a really defining moment for the company. Forma's been around for about 13 years. A lot of the early investors, had essentially tapped out. The company was largely funded through a series of collaborations that had been put in place over about a decade that brought about $900 million of funding into the company. The largest being with Celgene, which sunset at the end of 2018 as Celgene and BMS were coming together. They started to sunset a number of those relationships. We were fortunate enough to essentially establish a new investor base with the crossover, which RA led, raised $100 million, and that really set the table, I think, for us to be able to then consider the public markets. So, rolling into JP Morgan, plan A was essentially to approach the public markets with a timeline that essentially is what was executed on, which was, following data in our lead asset at EHA. That said, along the way, as we were preparing, S1 and all the work leading up to that, March, the pandemic occurs, the stock market sees fairly unprecedented volatility. It certainly raised a lot of questions in our mind about the path forward, but we just kind of kept the foot on the gas, moved things forward to be prepared so that we had the optionality. As Liz said, there were a couple of IPOs that we saw go out that were quite successful. So that, I think, reassured us that the possibilities certainly existed. And then there was more market activity that was very encouraging. There was even a point in time where we contemplated pulling in the timelines so as to not to miss a window. And then we backed off of that and kind of stuck with the original plan. So I think it was a very fluid time. I think, just making sure that we were prepared. It was work that needed to be done irregardless of timing an IPO. So if it was something that was pushed out to the latter part of the year, it was work that was well worth doing irregardless.
So that's interesting. So both of you guys orged up and took a fairly good amount of time from an org to closing of the IPO. And at least from what I'm seeing, and I'm curious to hear what CEO has been saying, that I think the timelines based upon the need for capital and the need for people wanting to get into the window have dramatically shrunk from org meeting to IPO pricing. Maybe CEO, if you want to hit that one, and maybe we can go around on that, because that definitely will impact people's decision making and how they want to think about an IPO relative to plans that you guys might have executed. You're on mute. There you are.
So yeah, I think they fall into two camps. And the first camp is really in accord with what Liz and Todd went through. These are companies that late Q3, late Q4 started eyeing the capital markets to try to see if there's an opportunity in the first half of 2020. A lot of these companies orged up, went through the process, and in February or so, we're ready to launch. Then we saw COVID hit and the uncertainty around it. And just like Liz mentioned, everyone kind of went on pause and said, let's see how this unfolds. And then we saw Zentalis and Kuros launch, kind of unprecedented 4-day roadshows, which people didn't think could be done. And not only were they able to execute it from a logistics standpoint, they had fabulous IPOs with great valuations and traded up and upsized their deals. And that's really when kind of everyone else said, we can do this too. And the banks started advising to follow on this footpath, and investment demand was there. And we saw the whole flurry in Q2, which I think ended up being the biggest biotech quarter in history for us as an industry. The second camp is a little bit more of a mixed bag. I think it's folks that have now tried to get into the momentum that we're seeing with, hurried org meetings and accelerated timelines that kind of came to end of Q1, Q2 timelines, very aggressive timelines. And some of those companies have already got out. Other things we're seeing in the second camp are folks who had a stalled IPO for whatever reason in 2019, picking up the pencil again and rushing to get back on file and take advantage of the momentum. So that's kind of what we're seeing. I think that summarizes the deals that we've seen to date so far at a high level.
Yeah, I mean, we're working on one of those. Obviously, can't disclose, but from org meeting to intended pricing will be under 3 months. So that's a little different cadence than, I guess, you guys took your sweet time, which is good. I guess you can do it to the time frame that you need to, and you didn't have to be the first ones out. Maybe just to dive a little bit deeper into the actual process, I want to make sure that the listeners get a chance to get some actionable advice and insight as to the nuts and bolts of how to do this. Can you talk about the process of getting to that IPO? How did you decide? Maybe I'll just start with the question about bankers, because that's usually an important question. How did you decide on which banks to select, and what did your process look like? And maybe start with Liz. I know you were at the company before Sean got there, and so that might have been something you were working on.
Yes, certainly. So obviously the banker selection process is a really critical one. We spent a lot of time meeting with, I would say, 12 plus banks just to really seek out who was going to be the best fit for us, really meeting various members of their team. And for us, clearly the bankers, the ECM team, the analysts are really important as a team in terms of selecting who the bank is. We ended up choosing Bank of America as our lead left. Really strong team overall, very, very strong equity capital markets team as well that really had very strong and broad reach as well. And so that was really a critical piece of choosing the lead left. Jefferies and Leerink are other two major banks and really bring strong complementary skills as well to what Bank of America did. The other key, I think, part for us was really making sure that we had good dialogue with the analysts. Somebody who really understood our story, believed in our story, was excited about what we potentially could do as well. And so the banker process, really being able to do diligence on success of past IPOs of them, as well as, getting input from our board. Our board is very sophisticated and has been through this many times in terms of their experiences with bankers as well. Obviously all played into selecting the team that was going to be able to support us.
So I have to ask, did Sean pitch you for the business, or what was that like?
Sean, let's answer that.
I think part of the way we sort of fell in love with the company was getting excited about potentially being involved in the IPO, and it's the old Victor Kayam Norelco razor. I like the product so much I joined the company. So
at the end, you ended up pitching them for a different reason, for your personal services, not just the banking services. Very, very fun dynamic there, I'm sure. Todd, what about you? How did you guys go about that process? Maybe just shed a little color into that.
Yeah, sure. I'd say there's a lot of similarities. So since joining the company, we met with pretty much the normal list of banks, connected with analysts. Some of them were certainly more engaged in the story, closer to the story. I think it was really important for us to see which analysts really understood the space, and then the banking teams, of course. And it's I think, as Liz said, a lot of it's around fit. You're working with these folks very closely in the process. We ended up with a pretty similar slate of banks. So we had Jefferies was lead left, Leerink and Credit Suisse, and it was a great team. Diverse capabilities that came to the table. And I really liked that. So they had a lot of different thinking at the table as we were drafting and things like that. And so we were very pleased. We did a bake-off process where we had a few members of the board join. We had, I think it was about 8 banks come through. to basically, tell us the story in terms of how to position the company. And it was worthwhile to hear those pitches and see how, it aligned with our thinking. And very happy with the outcome. It was a great team effort. Of course, the banks are part of it. We were fortunate enough to, not a plug for Goodwin, but we had a great Goodwin team here in Boston that was equally important in that process. So very fortunate.
Got it. And there was actually a relevant question that just came in about how do you define a good fit versus not a good fit? How do you tell? What does that mean?
Well, I think there's two elements. I think one is clearly just around understanding the story and what the company's sort of strategy is, how that fits in, how to position it in the marketplace. So it's sort of knowledge of the universe that we're working within. And I think that's true with the analysts as well. Some of them have different degrees of expertise. Our lead asset was in sickle cell disease, so sort of relevance there was critically important. And then I think it's just the interaction with the leadership team across the table. And that's, I think, like in any interview process you go through, you have a sense of working relationships and how that might play out.
Got it. So Sean, we have a unique opportunity to ask a recovering banker, how do you decide which banker is the right one to choose, or which bank I should say, and what are some tips that you would give to a CEO or C-suite executives listening in as to how to navigate this?
Sure. Yes, I agree with everything Todd has said, and Liz also, of course. But I think just from the lineup perspective, a complementary syndicate is mission critical. And I won't name any banks, but if you have two large bulge brackets on the top line, they're with the exception of the different personalities and the different people, and of course equity research being paramount. But you're effectively paying one gross spread, and you're getting one, if you follow me. So I think the big banks are largely identical from a footprint perspective. So having a complementary mix is important, which is precisely what we did, where we had a large universal bulge bracket to the left. Jefferies sort of a middle market, for lack of a better term, but they obviously have incredible capabilities. And then Leerink, a life sciences powerhouse, but boutique, exclusively focused on biotechnology. And with equity research being arguably the most important out of the gates, but having a complementary lineup is important. And I completely agree with Todd also. The understanding that personality fit, how excited is the individual, the lead banker, for example, with regard to your company, because a big IPO like Todd's could make somebody's career. And even if you have the senior coverage, but if you have an up and comer who's the day-to-day, understanding how busy they are, everybody's incredibly busy right now, but making sure that at least you have the perception that your transaction is the most important one that they're working on. And so it is a lot of instinct and probing and due diligence calls with regard to previous clients, understanding their working relationship. So that's how I sort of simple view of the world.
Got it. No, that's not so simple. That's actually very helpful. So I guess in the same vein of the IPO process, Liz, and I guess CEO, this would be helpful for you since you do a lot of this, but drafting an S1 takes a lot of time. It's not hard. It's time consuming. How do you think about that relative to your day job? And then for someone like you, who is not necessarily a CFO of a company, obviously that's now Sean's role. How do you think about different roles and responsibilities for the management team? What is really the CEO's job? What is the CBO or CFO? And help us think about getting the work done like an S1, but also who's actually doing the work.
Sure. Yeah, so I mean, I think the S1 process it's truly an interesting and obviously and can be a very intense one. I think in terms of maybe the tactile part about driving it, it's obviously you got a lot going on in your day job, but for all of us, this is a key priority. And I think getting it right is actually probably a really important part as well, because this is really your first really explanation of who you are going to be and intend to be as a public company. So I think for us, one thing that was really helpful was actually myself and our CEO spending quite a bit of time together, really just talking about our strategy. What is our positioning? Who did we want to kind of become to look like as a public company before you even begin to put pen to paper? Otherwise, you're spending a lot of time reorganizing and kind of building the plane as you go, as you're actually drafting it. And so I think the benefit being able to really be clear in terms of how you really would think about the company. And in particular for us, we have a platform technology, which is very innovative, broad reach, broad potential. And how do we really balance that with some really exciting lead programs as well? Our lead program in the clinic and data coming out of that as well. And so I think the pre-planning really helped. And of course, there's intensity in terms of the drafting piece of it, but having thought about that in advance was really helpful. And I think that's one role that CBOs can really help in terms of help crafting the story. What is the strategy? What is the positioning? We spend so much of our time talking to potential partners where it's very similar type of messaging. So I think CBOs can be really helpful in terms of helping companies craft those vision and begin to craft some of those message points as well. Clearly on the finance side, the finance team had to do the huge heavy lift as it relates to the financial sections and the MD&A sections associated with the S1, and was incredibly relieved when Sean came on board to really help with the real final pieces of getting that part of the process done. So I think as it talks about strategy, the CEO clearly is the chair of everything that's happening and really sets the direction, but it's really through partnership, I think, with the other key individuals on the team to really make sure that you can really prepare all the different sections appropriately.
Yeah, that makes sense. And CEO, I'm sure you've had your fair dose of drafting S1s. How do you think about what's the right mix of what your attorney does versus what the management team does, or the bankers? How do you think about that?
Yeah, I think every team is different. I think some management teams have a more baked version of their view of the company. Others are still kind of pulling the pieces together and figuring out what works for them and what doesn't work for them from a marketing standpoint. I see it all over the place. There's certain advisors that can come in and draft the first cut of S1 that helps put something on paper. Other management teams really want to walk away from the drafting session and say, here's the 5 thoughts I didn't think worked well, and then divvy out homework assignments. It just matters. It just depends on who wants to take the pen.
Yeah, I mean, look, I'll jump in here briefly. I think it also depends on the urgency. If you have 5 months to get it done, it might not be as urgent to have the drafting kind of pre-baked and ready by the time you org up. For the advisory work we're doing on the IPO we're working on now, we did the drafting of the business section such that when we orged up, it'll take no more than 30 days to get to a filing. And obviously the whole finance thing is a separate work stream. But I think it ultimately depends on the objectives, the speed needed, and as to how much resource to put into it. But as far as the attorneys go, I mean, you guys are good at drafting, but you can't provide the company with the strategy, right? So ultimately, it's still the company's vision. There's still a burden that the company has to take on independent of Goodwin, right?
Oh, absolutely. They need to tell the story. We can help put the words on paper and structure it and help flow, but it's management's story to tell. Yeah,
totally. And Todd, I assume similar with you. How did that work on your side?
Yeah, no, I think it was pretty similar. As I sort of alluded to earlier, we did our crossover in late 2019, December. So certainly heading into that process, we had gone through really defining the priorities of the company, who were going to be, what the focus areas were, the story, if you will. So that folded into the process. We were fortunate that our head of business development as well sort of took the lead, took the pen with the business section and kind of drove with a lot of internal input, of course, that first draft that we wanted to have before the org meeting. I led, the financials, contributed on all pieces, head of HR, dealt with executive and board comp, and then our, GC, played a big role factors in a lot of the overall process. It certainly takes a village. I mean, you talked about the day job. There's less time to do the day job for a while. And then once you get into the drafting where you have, 30, 40 or plus people, weighing in, every word gets looked at multiple times and changed multiple times. So whomever that original author is, they've got to have, I think, a pretty thick skin because you can say the same thing lots of different ways. But through that process, I think the story gets refined and improved. And then, of course, you need all the necessary support to whatever you're claiming in that S1. So it's a tremendous amount of work.
I broke my own rule. I was on mute. That's a faux pas. But you have 2 hours less of commuting time now, so you have plenty of time to do your day job in addition to your S1 and other responsibilities.
Exactly.
Great. So before we move on to just kind of other aspects of kind of the IPO, there was a relevant question that I thought I would bring in, thinking about the crossover round as an enabler of the IPO. And Todd, you just kind of hinted at this. What is really, in your view, the best practice? I know that the crossovers we're working on, it's absolutely critical to get the right number of investors. It's critical to have the right size and pedigree and a bunch of other considerations. But how do you think about the crossover as an enabler to your IPO to make it happen more effectively?
Yeah, well, and I can talk specifically to ours. I think it's probably situational, depending upon each company's circumstances. So as I indicated, the company, Forma had a long history, but really no current investors before the crossover that could be part of an IPO. So I'd say that the crossover was actually a very critical piece to enable us to become a public company. One, it set the foundation with really a solid group of core investors. So RA Capital led, but we brought in Baker Brothers, Cormorant, Wellington, Janus, and Samsara. So we had really 6 super high quality investors with an eye towards future participation, which was critical. It provided a validation of the strategy, the story, and where we're going. And I think that those all played a very important part as you then move towards TTW and Roadshow and as a means of bringing others into the story.
No, that makes sense. And we actually just did some number crunching, and I think each year the number of IPOs that have a crossover has gone up. I think this year there's only been one, perhaps, that didn't actually close a crossover round prior to actually getting public. But there's different definitions of what that means. Raising capital within 12-month window, is at least how I was defining it. So it is an increasingly important feature. Sean, is there anything you want to add to that? I know you were pretty heavily involved in that type of stuff, at least before.
Yeah, I mean, the crossover financing has certainly become the norm, and I think it's been good for the industry. 10 years ago we used to talk about crossovers, and it was like finding a unicorn. So it's just been interesting to see how the playbook has evolved, and I guess we technically did a crossover, but it wasn't with the usual suspects. So I also think it shows the importance of, in this sort of massive parallel process of how you're going to finance the business. And Liz, correct me if I'm wrong, I think it was on the order of 60 to 70 funds in the test the waters meetings. And we did, call it 2.5 rounds of TTW meetings, initially in person and then via Zoom or Net Roadshow. And that's been, hats off to the SEC and all the industry participants who came up with the Jobs Act, because that is, you're not going into the IPO blind. We were in a unique, I think a relatively unique position in that there were a couple of long-only large mutual fund complexes who gave sort of strong indications that they would be there and at our IPO. And we've done things a little bit differently. If our founders were here, they could articulate it better than I have with regard to funding the business. But we received feedback in the TTW process that gave us a lot of confidence that we could go directly to an IPO and not down sort of the railroad tracks of the quote unquote typical crossover. So it just shows the importance of having that optionality, and if a crossover with the sophisticated biotech investors is the right thing to do, you do it because it really helps with the IPO and it's become the playbook. But there are different ways to do things, and we were in the fortunate position that, like I said, we had a couple large mutual fund complexes say they were going to be there for us, and so we just did it that way.
Yeah, might as well save the dilution if you don't have to. I think what we've learned is that if there's enough runway pre-IPO, then that actually means you don't need to necessarily raise more. But if you truly are using your IPO as a material financing event because you need the capital in the short term, that's probably a bigger or better candidate for doing a crossover, so you can actually have more gas in the tank to have the pricing leverage with the investors. You're nodding, Liz. Do you agree with that, or how do you respond?
Yeah, I think the dynamics certainly have changed given what you can do in terms of upsizing right now. But I think that certainly is something to historically think about, as we thought about both and kept our options open on both. But you really have to do the planning as it relates to really what are your capital needs to really balance the dilution versus the needs to run the business.
Yeah, and we're not even going to talk about it today, but SPACs are the thing du jour to avoid the crossover, combine the crossover and the IPO into one. And I guess we'll see how that trend plays out. It's still fairly early days. You're nodding, Sean. Anything to add to that?
No, you think about the wire diagram and what your options are, and you have to look at everything. And I think that the good news, we'll see what happens with the SPACs, but it's also just another data point on the increasing sophistication of the life sciences capital markets. And we had general purpose SPACs. We're now seeing, and they were all invested in with the same hedge funds who are playing the SPAC and the options. Whereas now you're seeing some sophisticated life sciences investors anchoring, the SPAC. So I think it'll be interesting to see what happens. But again, it's a good option to consider, particularly in back to the original comment. Does gravity come back into play here, and maybe that that becomes more regular way deals, but we'll see what happens.
Yep, makes sense. So maybe just shifting gears a little bit to the actual process, and I've asked this question in other webinars more related to partnering deals, but virtual road shows. I think, Liz, you kind of answered this a little bit, that you met people in person before, and I guess Todd, to some extent, you as well, if you did the crossover round when pre-COVID. But presumably you both did do road shows, as I think we talked before the panel. And how did that work? What didn't work? And any advice you give to the listeners about how to optimize for that? So, Todd, go for it. Sorry.
Okay. Yeah, no, I didn't know we were directed.
Jump ball.
We did have the benefit of meeting with a lot of investors, face to face, leading up to our crossover round, and then again, through JP Morgan and so forth, and then leading up to the process before the world changed, in the March timeframe. But in the process, we did 50 plus TTW calls, and I say calls because I think less than 5% of our virtual interactions were via video. So it was usually a slide deck and just voice. Those were, I think, super efficient. It was over, a short number of days. It's tiresome because it's back to back. It's all different hours depending upon the geographies in the world in the US. So I think people lose their voice, because you go literally from one to the next. And then when we did the road show, we had about, I think it was 100 interactions in total. Probably about 40 or so that were just direct one-to-one meetings in a 3.5-day process. So super efficient. You're not getting on a plane. In my case, I didn't leave the basement here. But it's pretty rigorous, back to back to back. And I thought it was efficient. The technology worked. People were heard. The worst thing that happens is someone forgets to come off of mute. But by and large, it actually it worked quite well. And that was a bit of an unknown going into the process.
So Sean, how was your experience? And maybe just to piggyback onto that, do you see things going either back to normal or a hybrid, or what do you think it bodes for the future?
Yeah, so I agree again with Todd. It was incredibly efficient. I think Liz might have mentioned earlier, we were sort of first calls at could be, and we were on West Coast time, 4 or 5 a.m. and finishing up later in the day. And the other interesting thing, at least from my perspective, the typical in-person roadshow meeting, the bankers will always tell you have sort of 35 minutes to get through the story. There's a little bit of Q&A, then you run and get in the car service, and you spend a half an hour battling Midtown traffic. But it gave us the opportunity to do even hour-long meetings because there wasn't that travel time. So there was, less, if not any time between meetings. So, we had the text messages going around on who needed to go get a glass of water or whatever it might be. And that's how we sort of manage that. But, will it go back to normal? We'll see. It's amazing how readily, the industry collectively adapted and became used to doing, whether it was Zoom meetings or Net Roadshow, where you don't see the video. And I think we'll go back. I think we'll go to a hybrid. I mean, I don't know. That's at least my prediction. But at the same time, I think that personal interaction and relationship, particularly with investors who you might be looking for more capital in the future, is important. So, I'm looking back to getting on the road at some point safely, but I think there'll be a hybrid because it was such an efficient process that I don't know that we go back to the old days.
So, not to be put in a plug for the 3 cities where all of us are located, but is it a Boston, New York, San Francisco in person, everyone else virtual, or how do you think about that?
I don't know, Liz, if you want to chime in too, but it was sort of interesting in the sort of those non-3, the cities outside of that, or even the Mid-Atlantic, where typically you have T-Row and Rock Springs and so forth there, where they have some significant capital to put to work and influence. But some of the conversations we had with funds in what I would call secondary or tertiary financial centers, the Dallases of the world, they're used to not seeing people face to face, and so those meetings were almost more efficient because you didn't have the small chat as it relates to is the technology working or otherwise, because they do conference calls all the time. So I don't know. We'll see what happens.
Anything to add to that, Liz? Yeah.
Yeah, no, I'd echo that. I mean, I think that nothing substitutes face-to-face. I mean, at some point in time, you really do need those personal interactions. And so, I agree. It really allows you, the virtual setting really allows you to reach further, international as well. So you don't have to get on a long plane ride to be able to touch to some of those investors too. And so I think there's absolutely some benefit from it. I think the fact that actually it's pure audio makes it a little bit different. I mean, even in this forum, we're able to see each other. In other forums, is at least a video virtual rather than just an audio virtual. And so I think it'll morph over time. But I agree with Sean. It's going to be a hybrid going forward. Exactly how it settles in, I think, will still be worked out.
Yeah, I'm still surprised that Todd, more than half of yours were audio. I would have assumed they would all be video, but
No. Only maybe 5% were video.
That's what I'm saying. I would have assumed more would have been video, because audio is, you just don't have the same connection when it's remote. Physical, human connection.
I agree. I think there was concerns over bandwidth. I think that the investors were all spread all over the place as well. So that there's only a handful of people that requested it. I think in a similar to what Liz was saying, we did have the benefit. We met with a lot of investors not that long before the process. And I think that at least having one face-to-face meeting under your belt is hugely helpful, right? You just have a sense of, okay, the face with the voice and so forth. But I agree. I think that the idea of flying back and forth between Boston and New York for meetings is something that I think is going to happen way less frequent than it was just a few months back. So
I'm excited for that. So Sia, in a relevant, or I guess related question, virtual drafting sessions. I'm sure, again, given your spot, you are pounding out a whole bunch of those. How is that working? What's the upside, the downside? How do you think that's going to change when we get out of this?
Yeah, I've actually been pleasantly surprised at how well they've gone. Keeping on the system, on the Word system, and doing Zoom drafting kind of for the last couple of days before filing has worked well, versus the historical put in the document to the printer a week before, then doing hand markups. It's been quick, it's been efficient. Importantly, I think it's been a big cost saver for the companies. You're not dealing with a week at the printer, paying for catering and whatnot. The couple downsides, the energy really ebbs and flows. People are harder to keep engaged on video or phone, and people zone out. And then, like, what do we say in the last paragraph? And you find that it's not as efficient as being face-to-face with the printer. What I have noticed, I had one of my earlier ones, the CEO would give people a little bit of a hard time if they weren't on video, and to keep people accountable. and you compare that to other drafting other sessions I've done where no one's on video, and there's a marked difference. People are more accountable, people are more engaged. It might be more annoying, you have to comb your hair or put on something decent, but it's been more efficient that way. You know, going forward, I put it akin to the roadshow. I don't know we go back to the typical 4 days of the printer at the cost of, gosh knows how many $1,000s a day. Do we go to 2 or 3 days virtual, and the last day we all go to the printer to, you know, for final QC? I don't know, but I don't see us going back to the printer again for a full week.
Well, I do appreciate you combing your hair and putting on a nice shirt for this, so it is appreciated.
Always a good excuse.
But I guess that's an interesting view about you know, what is the right mix of virtual and not virtual, and you know, having to manage teams, we do ask people to go on camera, and that's a pretty astute insight that if people, I guess it's maybe intuitively obvious, should have thought of that if people are not on camera, they're probably doing other stuff. I can assure you that everyone on camera right now is focused on this webinar. We are not doing anything else because you can't get away with it if you're on video. So that's actually a pretty interesting view, and it seems a little aggressive, but I think it's probably the right call if I had to guess. I guess in coming back to you, Sean, just thinking about, without kind of repeating what you said before, you know, based on your prior banking days and the book building process, any other differences from the IPO perspective besides the roadshow that you think would be helpful for people to understand or maybe optimize in this world?
Well, I guess there were maybe it's a couple things. So maybe one process oriented, and not sure what Todd did or CO's recent experience, but you know, we had a heightened sense for market risk, and so we ended up the way our Q1 audit worked out from a timing perspective. We ended up flipping to public on a Monday, which under normal circumstances doesn't seem like a big deal, but you have with these abbreviated roadshows, you have the 14-day or the 2-week cooling off period, or whatever its seasoning period, or whatever the technical term is, which meant that we couldn't start the roadshow until a Tuesday. And it's just, in my 20-year experience, it's sort of customary. You print the red, you put the price on the cover, and you do the teach-ins, and the analysts do their, you know, the teach-ins to the Salesforce management presentation. Then you start the roadshow, and the Salesforce makes calls on that all in one day. And that just was sort of convention over the years. But you know, you in fact can print the red, you know, during that 2-week seasoning period, but the institutionals, you just can't start the roadshow, and the sales force can't solicit orders. So you know, that sort of dawned on us in the middle of that process, because none of us had done a 3 or 4 day roadshow previously, and even on the banking side, where so anyways, it's a long-winded way of saying, if you're going to flip to public, do it on a Friday, so you can start the roadshow on a Monday. And that's precisely the reason why we did a 3-day roadshow, is because we didn't want to take the market risk over the weekend. And but printing the red on a Monday, even though the sales force couldn't solicit, they could set up a roadshow, and we actually got inbounds in terms of orders that were unsolicited on that Monday. So it's a long-winded way of saying that flip to public on a Friday, so that gives you a little bit of more optionality with regard to the timing of your roadshow. And again, it's back to the importance of the TTW process, where, and I think in Todd in particular, where you have the crossovers, you start to know where your book is coming together before the roadshow. So you're not going blind. And at that point, there's some tactics and messaging as it relates to, you know, the first day, are you 1 times covered, you 2 times covered. So doing some of that informal book building, although you're not soliciting, to be clear, upfront, is mission critical in these short roadshows.
No, that's awesome. Tactical insight that I certainly wouldn't have gleaned from being on the outside of your IPO. I guess, you know, CO, just to flip it back to you relative to process, besides the drafting, is there anything else that's materially different or better or worse in the process from your view that might impact the people listening on the webinar?
Yeah, I guess a few things. One interesting thing I was thinking about when Sean was talking is, printing of the reds. We're not printing anymore. So there's no more arbitrary kind of 7 o'clock Friday deadline to be done with the document, hit print, and make sure books get to New York and New Jersey by Monday morning for teach-ins. We're seeing deals kind of slide into the weekend before pencils down. We hit, the virtual print button. So it's giving teams a little bit more leeway to get the deal done, which is helpful for lawyers like me that like to go to bed at night. But nothing else really. It's just, the 4-day roadshow has been really interesting. There's one deal I think did a 3-day roadshow. So it's just completely accelerated and full steam ahead.
Got it. So now that we'll fast forward, we got public. Congratulations. Now what? So what does this do to change your company, your strategy, your execution? Maybe Liz, if you could talk about the implications and what this means for you as a company.
Sorry, I was on mute there for too much. So as it relates to going forward, really, it's all about execution. I mean, I think that's really where our focus is. Clearly, maintaining our relationships with the investor community is an important part of that as well, but it's really executing on the plan that we laid out. And so that's how we're focusing going forward. I think in this environment, probably the most challenging thing, and probably for Todd as well, is we're all clinical stage companies. And, how do our clinical development continue in this world? We're certainly pushing forward on that as best we can. And I think that's really a bit of the uncertainty more going forward now. But it's really about execution against the plan that you've laid out, and to be able to make sure you're hitting the milestones that you've laid out in front of you and that you've talked to the community about.
Makes sense. Todd, go for it. Yeah.
I agree completely. It's all now in front of us about execution, driving the programs forward, to sort of, achieve the promise that we believe to be there. I think maybe the one other slight change given the raise and what that provides us is we can move aggressively in terms of preparing for success. So when we think about the next set of studies, lining things up, teeing things up like your clinical trial materials and such like that ahead of time, so that you can really not miss the beat as you move these programs forward. It helps enable that, and we'll also be looking at different indications. So we can just be, I think, a slight bit more aggressive, but by and large, we're sticking to the plan that was outlined at the onset. So,
got it. And maybe back to you, Liz. We're in kind of a ping pong fashion here. So public companies have different views of business development than private ones do. I think there's different implications. How investors will view the impact of a deal might be different. I'm curious if your thinking has changed at all from a business development perspective as a now public company.
Business development remains and continues to be an important part of our business going forward as well. I think now being a public company and having access to the public markets, we will certainly think about things a little bit differently. We were fortunate enough to really retain our programs going forward to really maximize the value there. And that's a conversation that Sean and I have all the time is making sure that we're really doing the most for those programs and doing the most we can in research. So I think we'll be thoughtful certainly around thinking about business development and, are we better off continuing the investment on our own versus seeking partners at certain times. But it's always an important aspect to balance financing as well, depending upon what your overall strategy is. So things will change a little bit, but it'll always be an important part of the dialogue as we think about the forward progress of the company as well.
Okay, Todd, back to you. Same question. How does BD change? I know historically Forma was a very active BD company, but how does that differ now with being public?
Well, the former, I'll say, 1.0 version was more of a platform company, deep expertise in chemistry screening, and had tons of partnerships they were very highly successful securing those. The model is a little different going forward. I think with the public funding and sort of the strength of the balance sheet, I think we can be a bit more selective in terms of when we contemplate partnering, certain geographies and things like that for some of our core assets. But we also have some non-core assets that aren't sort of mainstream to the strategy that we will look to partner. But again, I think the funding gives you that a little bit more flexibility. In terms of maybe taking something that has the best terms, for the company.
Yeah, and I guess I put you both in a tough spot because now that you are public companies, you're also restricted in what you can say. So maybe I'll chime in briefly just to give a thought on this. At least in my experience, and Sean, feel free to correct me or disabuse me of this, that investors want the lead asset to be unpartnered when it's pre-IPO, because fundamentally they're investing and they want to be able to capture all of the upside. It used to be you needed the validating partnership, but then a partnership on the lead would actually be potentially problematic. And I guess once you flip public, the stakes are different, where if you're going to do that deal, it matters what your market cap is relative to whatever partnership is. It has to be material enough. It has to be retaining enough value. If you just do a straight out license, you're probably going to be up the creek, so to speak. And we saw that. I won't name any specific companies, but not too long ago, someone out licensed their lead and the stock took a dive, actually much bigger than the upfront that they received. So thinking about BD strategy and deal making pre-IPO versus post-IPO, in my experience, it is different. It's important to both sides, but what type of deal you do and for how much and when, I think it does make a real difference. Any comment on that, Sean, just overall?
No, I mean, I think that's right. It's multifactorial too, and I think it's, again, back to one of my original points on the evolution of the life sciences market and the sophistication and depth and breadth, and that oftentimes, let's just rewind 15 years ago, just making it up, these companies were funded on shoestrings, and the clinical trials weren't powered, as they are today, and the management team maybe on their first company, and not deep-pocketed VCs. And so that partnership was critical for public investors to say, okay, it's validated. Whereas now you have teams who are on their third or fourth company. You have very sophisticated, deep-pocketed investors behind the companies, and they're running the right trials with the right people. And the science is evolving, I think, in a positive direction. So it's a little bit different times, but completely agree. We've seen oftentimes a bad BD deal can crush your stock in the public markets, or an unexpected BD deal, let's put it that way, is not good.
Yeah, and maybe CEO, I'll end on you. Just any insights? I'm sure you've worked on many a deal on how things change for a company once it's public versus private.
You mean just like under the regulatory scheme? I mean, obviously, as you alluded to, the management team has to get a little bit more tight-lipped around pontificating what their plans are. As you put Todd on the spot, and he acted well to it. I'm sure his counsel will be happy. It's operating under, the public spotlight at that point, and we're much more careful about one-on-one discussions with investors, whereas historically you may have had a great open dialogue with Red Mile or whoever. It gets a lot more scripted, and it gets a lot more coordinated of what we're saying, when we're saying it. We're thinking about levels of materiality. Do we really want to press release something so immaterial? How's that going to look in the future when how we don't want to? There's just a little bit of a tighter regime that we start operating under. Management teams, as Sean has said, most of them have been through this. They've been around the block on one side or other of the fence. So it's nothing new to them. It's just reminding them and having good level of communication open.
Awesome. Well, guys, I really appreciate you joining. Liz, Sean, Todd, CEO, thank you so much. We are unfortunately out of time. As a quick reminder, there'll be a link to the recording that will be sent to all the participants. If we didn't get to your question, we'll do our best to answer in writing everyone's questions that were submitted. Again, not legal advice, no selling securities, but we'll do our best to be helpful. We look forward to seeing you all hopefully in person soon. And in the interim, obviously, everyone, please stay safe and continue to social distance and do the great work that our industry does. So thanks for joining.
Great. Thank you, Jeff.
Thank you.
Yeah.